Well, let's bring in the market panel. Joining us now, Adam Crisafulli of Vital Knowledge and Victoria Greene of G Squared Private Wealth. Good afternoon to you both. It's good to have you on. Adam, I'm going to start with you because, yeah, the market took a breather here in this final trading day of 2023. All the major averages finished down, but only fractionally. It has been a torrid run since the end of October. Can it continue, or are we due for some consolidation because we're so overbought here?
So the answer to both questions is yes. I think it can continue, but I do think that the market is due for a 1 to 3% pullback just to consolidate, digest the recent move that we've had. Prices are overbought, sentiment's a bit complacent, valuations are a bit rich. So, I think that a pullback would be very healthy, but I do think that the market has further to run for all the same reasons that we've been rallying since October. So ongoing disinflation, you're going to see the CPI, the PCE continue to drift lower throughout 2024. Shelter, the shelter component moving lower is going to be an important driver of that. That will lead to Fed easing. So the market's already pricing in an aggressive wave of rate cuts this year. But I think simply following through on that, if the Fed comes through with rate cuts starting in March, that's going to be important. And then resilient earnings. Earnings are really going to be the wild card, the critical factor. So, if you look at the last few earnings reports, Nike, General Mills, FedEx, they disappointed on revenue, but they were able to preserve earnings through cost cuts and other operational levers that they pulled. And if other companies in corporate America, as we get up into the Q4 season in the coming weeks, if they are able to perform similarly, I think markets will be relieved. And those three factors, I think, can help push the S&P, towards 5,000 and above by the spring. But in the near term, a little bit of a pullback would be very healthy and welcome.
Victoria, do you see it the same way, that the trajectory is probably, despite maybe some consolidation in the nearer term, that the trajectory is higher next year? And if it is it going to be the same types of factors, and by the way, the same types of sectors that are going to power it?
I think there's going to be a little bit of rotation. I think your interest rate sectors, if you look at actually what led November and December, it was REITs. I know utilities didn't quite get the same bump, but if you look at the top performing sector, it wasn't technology the last 2 months. It was REITs because of the pivot. So I do think some of these more rate sensitive sectors, I'm very bullish on REITs next year. I do think you'll still have leadership from technology. And one thing I love to do is step back and look at the 2-year chart. If you look at where we ended 2021, we are literally 3 points off of that ending value today, because we closed right there at 47.66. And that's where we ended 47.69. So 2 years, round trip, not a whole lot accomplished. So you do have room for multiple expansion. You have a little bit of room to run. Breadth have increased tremendously. Small caps look like they may be poised for a nice breakout. Very cheap relative to their large cap peers. So I think you'll see this broadening out. That is not just technology discretionary. You could see some leadership stumble and rotation out just because they are very, very pricey. But again, if you look at AI as the new internet, you're in the early innings of that cycle.
Okay. The round trip element of the S&P, Adam, as we do talk about it, closing in on a new all-time high. Just looking at your notes here, you're making the argument that even if we reach that level, whenever we reach that level, that's actually not really the real high for the S&P yet in terms of meaningful gains for longer-term investors.
So, yeah, I think you kind of have to adjust that number. So on a nominal basis, we're kind of right at the cusp of reaching the levels we were at 2 years ago. But if you adjust for inflation in the last 2 years, you'd almost have to get to 5,400 just to kind of break even, given what inflation's been. So, there's still room to run. Obviously, I think you have to factor in earnings and rates and all that. But the real high in the S&P still is several hundred points above where we are right now. So there's definitely more room, for room to run on the upside.
Okay, Victoria. You just mentioned some different sectors. How much of your investing thesis hinges on, for 2024, the fact that we get a soft landing? Or are you factoring in the possibility that a recession could happen?
No, 100%. Got to be a soft landing. If the Fed's cutting rates because of a hard landing, I think it's a completely different market scenario. And so that's something you have to be very willing to be nimble and adjust as we get data in, because right now you have a lot of expectations baked in. But I look at it and I think 150 basis points, maybe a little bit too aggressive, March a little bit too early. But if they're easing because of the disinflationary properties and they're trying to maintain inflation, that's a different reason to ease rather than the economy's falling apart, unemployment's rising, rising and we're trying to stimulate the economy. So I think you have to have an understanding of where the data is leading us. I will caution some of this deflation has definitely come from the good side, a lot of it on the energy and oil price side. So if we see that creep up again because of any Middle East conflict continuing to grow, oil prices creep up again, that was a big driver of inflation before. So I think investors really have to be monitoring the data, understanding what may be driving Fed policy. Is it because we're fighting deflation, or is it because we're fighting a slowing economy?